Hello traders, welcome to my YouTube channel again. Okay, so we're going to be going into the episode 2 of general SMC trading method, right? So we are going to be talking about the POI logic. And make everything as easy as possible, step by step for you guys. Okay, so the POI logic, that's what we are going to be learning today. So when you mean the POI logic, what does it mean? Now in trading, there are certain general phenomenon that applies to almost every concept in trading, and that's actually mean something like where people look to get into the markets more. Example, the percentage of people that are trading a particular market, let's say USD JPY, the percentage of people trading a particular market along this impulse is very reduced than the percentage of people that are trading around areas like this, because these areas like this, the markets happen to react again in the future. What I mean is, if price did a reversal or a continuation at a particular area like this, let's say this is a continuation, price got to this point, and it's going to be a reversal in smaller time frames, but on the time frame, let's say we are talking about a 15 minutes time frame, it's going to be a continuation. But if it's on a 1 minute time frame, this is going to be a reversal. Okay, so people know, or not really people know, the market behaves in a way that areas like this, if you mark it out with any tool on TradingView, you find out that price come into it and do something, right? It could do this, or do this, or do this, or do this, right? But such areas, price like playing around them. So this is why trading is in such a way that in technical analysis, especially, we believe that things that happened in the past tend to occur again, meaning place where prices react to in the future, in the past, price is likely to react to those levels again. Now, not that nobody's looking for those areas to be respected very accurately. They could be very accurately, or they could be something like this, or just a little bit, or it could be close like this too. So it's something that we all know. Now, in price action trading, we use support and resistance to mark areas like this. They call them support and resistance. I said it in episode 1 video, right? While in SMC, we make use of supply and demand. Okay, so support and resistance are areas where price reacted to. All these areas will be marked. Now, it must not be the origin of the way I'm doing this. It could be something like this also. Right now, sometimes the market is choppy, uh, very very choppy. Okay, so what do? They mark out areas like this also because they believe price will react there in the future. So what do? When the market is bearish, for instance, they look at these old areas, and what happens? They try to look for sell around here, right? Because the market is trending bearish, and this is a point of an area where people are interested in. Hedge funds, retail traders, and everybody, we are most interested in levels like this when the market is trending down to look for sales. So once the market is at this level, right, people go to the smaller time frame People go to the smaller time frame and start looking for sell opportunities. Now, every system or strategy have a way they look for their entry criteria, which will be in the smaller time frame, so that your stop loss can be smaller instead of putting it on the higher time frame, so that your stop loss will be big, right? Because we all do day trade. We don't all do day trading actually, but most retail traders participate in day trading and scalping before we get swing traders and the rest. So most people like the stop loss a bit tighter. Okay, so they avoid putting stop loss in time frame like 4 hours daily or 1 hour, mostly 15, 5, 1 minute, 3 minutes. So that's how the price action logic works. But now coming to SMC, I had to first of all show you guys how the price action logic work, so that you guys can understand. For those of you that have no knowledge about price action trading, right, you can understand what they do. So into the POI logic now, the word POI is ICT's terminology, right, which is point of interest. Okay, so point of interest in the market are the same thing as support and resistance, in which retail price action traders trade off. But in SMC, point of interests are in different kinds, right? Now, all of them work and all of them do not work too. So what I mean is, when I mean all of them work, they have advantages and where they worked, and they also have disadvantages and where they do not work. As you can see, the market cannot favor your strategy 100% of the time. It's not possible, right? So it's just for you to make sure you stick to a particular trading system and allow profit and loss distribute themselves. All right. So in SMC, we have point of interests, and I'm going to list them. We have the order block, which is the most popular. We have fair value gap, which is the FVG. We have the breaker block. I think these are okay. I think we have OTE2 something. Yeah, I think for now, let's use this, right? So these are the point of interest we have in SMC. So I'm going to be talking about the order block, right? The order block is always found at a demand level most times in the markets. When I mean the demand level, the origin of a swing to the upside, the origin of a swing to the upside. Now, you can find other blocks around here, okay? You can find them always at the origin. Now, when you look at the origin, is this the whole origin that's the other block? No, okay? So according to ICT's concept, other blocks are the last candle before the actual push. Now, if price is going to go down, if price is going to go down in an impulse when banks are influencing things, the last candle that occurred before that is this. Okay, so if price is going to go down like this with speed, what we want to pay attention to is the previous candle, which is this, right? So that previous candle, we are meant to draw it out. Now our rectangle tool we're going to use to draw is going to be the same height of the candlestick. If it had wicks, I personally add the wicks to it too, so that will be the area of supply. So this area is known as what? Supply or order blocks, sell side order blocks, right? Why is it sell side order blocks? Is because it is the last candle before a drop, a rapid drop in the market. Now, this rapid drop, if we assume it is one red candle or stacks of red candle in a pattern, this should be a green candle, okay? This should be a green candle. The other block is always the opposite candle before the rapid move. All right, always note that. The other block is always the opposite candle for a rapid move. We all know that bear candles are red, right? So when it drops down with speed, the previous candle before it that is considered to be another block should be green. Okay, that's an order block. So we call it a point of interest because oftentimes banks hedge funds trade back into this area and then dump prices further, right? So we tend to look for sales here, right? Now, what I'm doing is I'm trying to give you an example of a downtrend uh, scenario whereby we take the supply zones or the origin of the drop. The origin of the drop is known as supply and also called sell side order blocks. And this is the example I'm giving right here. The buy side or the bullish move, the uptrend um, example is the inverse of this. So what is the inverse of this? Let me make an example of that. The inverse of this is, okay, sorry. Okay, the inverse of this is when price moves so high in the direction to the upside rapidly, influenced by banks or hedge funds. Okay, we know that the previous or the last candle before that exact move is known as an order block, which is a buy side order block. Why? Because it was the candle that formed before a bull run. So it's called a buy side order block and also called what? A demand zone. So we know that once price trades back into it, we look for buys here to take things higher, right? That is how it works. So this is the picture that goes on whenever you see uh whenever you see me draw something like this, price moving to the upside. Most times banks push the price down to these levels, and then this green level was drawn from the last or the previous bear candle before the bull run. Remember, this is a bull run, which is supposed to be a green candle. So the previous candle before it should be a bear candle, and they're going to mark the exact height of it. Okay, so that's about the order block. That's one, one example of a point of interest. So I'm going to show you guys in chat how it looks like. Okay, so show you any time frame. Okay, so this is called a sell block because that was the last bull candle. You see, price dropped massively. So we are paying attention to the last candle before it, and we are drawing our order block, right, to fit exactly the height, including the wicks. So you can see when price ran into it, you see price just fell back down with precision. Now there are other rules, to other blocks, right? Which I'm going to say in this video. So I'm going to look for one example of where a buy side order block was initiated and was used properly. As you can see, this is the last bear candle before the push. Most times when I'm drawing my order blocks, I do draw it to cover any wick below, right? So see price traded back into it, and then you see price went up so high. I just showed you examples of both the bearish and the bullish order block, right? So now there are certain rules, right, that makes supply and demand or other blocks different completely from retail price action logic, right? So what are those rules? Now in retail price action logic, a support or a resistance is said that when they are tested multiple times, when it gets tested again and again, right, it makes the area stronger and you should sell more whenever it gets back there. Okay, but in supply and demand, which is other blocks also, you don't do that shit, right? You don't. Meaning, if price gets back into this area, you want it to respect it once and you want to be involved in it once. If you come to the market and it has been respected and you see price coming back down into it, we ignore it because it has been used. So we use other blocks just once. So we draw fresh one as the market keeps forming, right? We keep drawing fresh ones. We do not use old ones the way retail price action use old support and resistance. We do not. We make sure it's fresh and we use it just once. What I mean is using this market condition as an example, we know that if see what price did, price came back once and fell. Now, if it was retail traders, retail price action traders, they are going to consider this as a resistance zone, and this is how they can draw it, something like this, to cover the whole region, right? Good. So now, after this reaction, what happened? And it comes back here, they want to sell even more, right? Or they can use an area like this, make sure it touches where they want. Okay, so as you can see, it touches here, it's sold here. So they'll try to sell here again for some of them. But as you can see, it failed. It came back down, you know. People, some of them will try to buy on this side, thinking it's a break and retest, and then so what it did, and then went up and then it fell down. So it's just something that is different. Price action retail trading has its own advantage and disadvantages. SMC has its own advantage and disadvantages. No system or concept is the holy grail. Just choose what works best for you, and you'll see results from it in the long run. Okay, so that's all for other blocks. Yeah, we use it just once, and see you guys in the next video. Next video, we're going to talk about I think FVG and breaker blocks. Okay, so see you guys. Do well to like and subscribe to the channel if you found this helpful. Go on your chat and look for these things I showed you, and wait for the next video, episode 3. Right, peace out.